Hello, ARQ clients, friends, and colleagues. It's Rich Siegel with ARQ Wealth Advisors. It is Friday, about 4:30 p.m., April 3rd, and this is just going to be a quick market update for you. As you can see here behind our disclaimer language, we have a new website that we'll be launching in about 3 or 4 hours from now. There should not be any interruption at all, but if there is, it will be 15 or 20 minutes. The new website is going to be a little more polished, easier to navigate, more resources. And if you want to get access to your accounts through this site, you simply click on the client login here, and you can either log into the client portal or the TD Ameritrade website here, okay? So this is going to be a brief video, lots of activity again this week. Let's start by looking at some of our slides from our friends over at JP Morgan. All right, so this is a chart that shows the market levels along with some valuations. Take a look at up here. You'll notice that this was done as of 3/31. So on 3/31, the S&P 500 closed at 2585. Today, we are 3.75% below that at 2488, okay, as of 4/3. And the E in PE will be hard to forecast, but based on their forecasts, that'll be about a 30% drop in S&P corporate earnings for the year, which is a huge drop. Forward PEs would be around 15.4, or after today, maybe closer to 15 times. So 15 times earnings is well below the 19 times that we were at just 6 weeks ago. Additionally, I think what's very interesting is that the yield on the S&P 500 today is 2.4%, while the 10-year Treasury, I believe, is closer to 0.6% today. That's a good sign. Typically, when the S&P's dividend yield is much higher than the dividend yield on the 10-year Treasury, that basically forecasts pretty good growth potential on stocks for the future. Over here, what I wanted to draw your attention to is this drop we had. This is just absolutely straight down breathtaking. We're probably down to about here. I drew a line to show you that from current levels out to here, I mean, we're basically back to 2015, 16 levels on the S&P. So from peak to trough, the S&P 500 was down 34% as of 3/23. And the Dow on the same date was down 37%. Today, at the close of business going into the weekend, the S&P is down about 27%. So we're fairly close to the bottom, maybe 7% away. We think that this low, this 323 low of 34 or 37% will retest. I said that on the last video. That's typically what you see in these tremendous panic sells. Let's shift gears for a moment. I want to look at one more JP Morgan slide. That would be over here, slide 6. And I think this is very interesting. Again, I drew a red line over here. And all this is showing you is that if the forward price to earnings ratio is 15.4 times, that over the next 5 years, historically speaking, you could expect returns of about probably 9.5, 10% per year on average for the next half a decade. Whereas if you had higher PEs, let's say the PE was 20, okay, your forward opportunity on returns is probably in the low single digits. So where we are today portends pretty decent returns for the next 5 years or so. It's not going to be in a straight line. It's not going to be 9 or 10% per year. You might get a negative year in there. You might get 2 negative years. You might get an explosive upside 40% year. So just keep that in mind. Something else I want to show, which I think is really interesting. These types of panic sells, this is very symbolic of previous panic sells. This is the 1987 Black Monday crash. And you can see here that this current market is the black line. The Black Monday, October of 87 crash was the blue line. Very similar pattern. You tend to retrace here this reflex rally that we had last week, 2 weeks ago, up about 17 or 18%. Then you tend to retest the low I would say we're probably in this range here. Then once you retest that low, then it tends to chop around for a few months while the data comes out and verifies why the market's down in the first place. And then after things get healthier, then you start into a new bull market. That's the typical pattern. A few more things here that are very interesting. This right here, this chart is the breadth of the market. And today what you'll notice is while the market was down 360 points or so, there were 866 stocks in the NASDAQ that were positive, 2,300 and change negative. On the New York Stock Exchange, 846 positive, 2,900 negative. This is a good sign. When the market first started going straight down, everything was down. Nothing was up, basically. So this breadth is showing that there is a dislocation or a bifurcation. Some stocks are actually starting to do well. Another good sign is that the VIX, the volatility index, the fear index, was 85. Now we're in the 40s. So a market that retests the low historically with better breadth and lower volatility tends to indicate a bottoming process is starting to begin. Lastly, one more chart. This is money flowing into cash, and this is cash holdings in the credit crisis. This was a little bit more drawn out than this recent panic sell that we had, but you can see that cash was $4 trillion or so. And if you draw a line right across here, we're actually above that now. So essentially, when there's a flight to safety, a flight to cash, once this starts to come back down again, like this did, the market starts to go back up again, because this money tends to go back into stocks. So all of these charts here are indicating sort of like a capitulation or a bottom forming process. So we feel that the market will go back down and retest that low from a couple of weeks ago, but it's coming back down in a more orderly fashion. We're seeing moves in the market of 2, 3, 4% instead of 6, 7, 8, 12%. So it's not as unsettling. The data is horrible. The unemployment filings, the GDP, the earnings, it's going to be bad. And the market is already pricing that in. The market's pricing in the worst case scenario, okay? So lastly, I will say that our clients are diversified, and when this first started to roll over and get ugly, almost everything was going down together, and now we're starting to see bonds and other safer assets behave better. We're seeing municipal bonds, corporate bonds, treasury bonds start to provide an actual hedge to the market, whereas 2 weeks ago, things were a little bit more correlated. So anyway, I hope this is helpful. Enjoy the weekend. Again, the market does not go down in a straight line. There are going to be fits and starts. And as more news comes out, hopefully some therapeutics and some better news, we hope to see the market have some very big rebound days as well. So have a great weekend, stay healthy, stay safe, and we'll speak to you soon.